Good afternoon. Welcome to the session entitled Our Homeownership Moonshot, Building 20 Million Homes by 2030. This session is designed to bring to the fore and to discuss both the sort of status of the problem and solutions that we believe need to be brought to bear on what we think is one of the greatest problems affecting the American economy and opportunities for people to build wealth in this country, namely the lack of home ownership inventory in the country and what we need to do about it. So this idea, the Moonshot idea, essentially tracks what President Kennedy did in 1961 when he announced that we put a man on the moon by the end of the decade. We think we need that kind of an investment here, because without it, we will continue to see an upside down housing market, the likes of which I have not seen in my lifetime. Even in the heyday of the bubble before 2008, I don't think we had as much shortage of inventory as we do now. How did we get here? We have 4 terrific speakers for you to talk about how we got here, what the state of things is, and how we move forward. First, Selma Hepp, who is one of the leading housing economists in the country and is at CoreLogic. I think she's uniquely positioned to kind of give us a level set on where we stand right now with inventory and sort of how we got here. Followed by Kara Ward. Kara is a former Treasury official who now advises folks on both sides of the political aisle about the need to do more in the housing and housing finance space and what kinds of policies she thinks we need to be thinking about. But she's also tracking current policy now, and we thought it'd be helpful for you to hear kind of what the state of current policy is. Followed by Marissa Calderon. Marissa is our CDFI executive director. Before that, she was the executive director of the National Association of Hispanic Real Estate Professionals. She is uniquely positioned to talk about home ownership, both from the need to build back better from an infrastructure level, but also in particular to talk about communities of color and how we need to focus on supporting communities of color in their efforts to gain home ownership opportunities. They are the principal victims of this current crisis. And then finally, Phil Bracken, a longtime friend of NCRC, former head of government affairs for Wells Fargo, currently the head of government affairs for VantageScore, really a guy who understands the mortgage industry, understands the housing industry, as well as anybody in the country. So we have an all-star panel for you. I am looking forward to this, and we will, when we finish, come back to Q&A. I hope we get a lot of questions from you, because I think it should be a robust conversation. But now, if I may, let me start with Selma Hepp. Selma, take it away.
I'm not sure if I was on mute or not, but thank you for having me. I have a number of slides to share with you. I hope you find this information interesting, but I do believe that this group is wonderful to be presenting on this topic. So I really look forward to participating a little bit later in our discussion. So with that, I'm going to share my slides here. Just give me one quick second. Okay, share my slides. Okay, do you guys see my slides? Sorry, it's kind of switching between the... Yes, okay, you can see my slides. Okay, going back to the slides. All right, so what I'm going to talk about is what's going on with the inventory. I have some data on millennials and their affordability challenges, as well as their participation currently in the market. I have some data on what's happening with forbearances and how they may play out in terms of future inventory. That's all for my slides. So I'll pass it over back to Ed after that. But the slide you're looking at here is the inventory of homes for sale, number of single-family homes for sale in light blue line. So this is the MLS data. This is the number of homes that have been available going back to 1982 for sale. you can see here that over the last few years, that number has been declining. It actually has been declining over the last decade, but especially took a dip in the last year in 2020. When looking at what the average for availability of single-family homes for sale has been, historically, or at least going back to 1982, it averaged 1.9 million, which is the red line going across. And you can see here that we are currently even below the 1 million. So we are more than 50% below what the historical average is. On the other hand, if you look at the dark blue line, which represents the number of households in the US, that number has been trending up. Naturally, we have the more population we have, the more households we have. And so the discrepancy between the two, which I'm going to show you in this slide here, is even more evident when you put it, it's basically the same information in this slide, just presented differently. But what I'm showing you here is by decade, the change in housing inventory. This is all housing inventory available out there, and the change in population. And so where the picture becomes more stark is over the last 3 decades, where you can see that we are adding 33 million people, 27 million people, 20 million people, but at the same time, we're adding only about 10 to 13 million new households. So in other words, over the last 2 decades, we added more than twice as many people than the number of housing units. And that wasn't the case prior to 2000. As you can see on the left, the left 3 sets of bars, there was a much more balanced relationship between housing inventory and total population. Now, since the beginning of the pandemic, so this is now just focusing on the last couple of years of data, and it's a year-over-year % change in new listings, so newly available inventory that comes online, and then active inventory. So that's everything that's available online. And a couple of things to point out here. First, the light blue line is active inventory and suggests that even at the beginning of 2020, we were trending at about 10% below previous year's inventories. And that's consistent with the couple of slides I showed you previously. But then the darker blue line shows you what's happening with new listings. And you can see that with the onset of the pandemic in March of 2020, the number of new listings drops precipitously, down 50% on a year-over-year basis. And it starts picking up somewhere in second part of last year. And this is, again, when you think on a year-over-year basis, so it's not still contributing significantly to the active inventory, because the active inventory is declining at the same time, overall inventory. The listings take a dip again at the end of the year. That has to do with more cases. When we were ending last year, at the beginning of the year, it was sort of height of the pandemic, new infections, and this is where the new listings took another large dip. And then in April of this year, we see a 41% increase in new listings, which in theory it's a positive number, and it seems like we're making progress. Nevertheless, this is comparing on a year-over-year basis. So this is comparing to last April. And if you look at that 50% of decline last year, it's what they've been calling the base effect, especially now in recent discussion about inflation, they're talking about base effect. So when you're comparing to things that happened last year, you have to take into consideration that the economy and the housing market came to almost a full stop. So it's not necessarily most effective way to look at the inventory information by looking at last year's level. So what I'm doing here in the next slide is I'm comparing the new listings to where they were in April of 2018. And picture, unfortunately, is pretty much the same, where I'm showing you metros with largest declines, metros with smallest declines. Overall, pretty much all the metros have had declines compared even to 2018 numbers. But some metros obviously had a much larger declines of as much as 50%. And those tend to be the areas where we've seen most increase in demand or lack of new construction supply. So Kansas City has been one of the cities that fared pretty well during the recession for various reasons. But then we have Texas. There is the affordability the affordability opportunity for some people moving from other parts of the country. And then we have some markets in California that are relatively more affordable to, say, LA and San Francisco. And then we have markets where people generally have been tending to move in recent years: Tampa, Austin, Raleigh, North Carolina. And then on the other hand, here you're looking at where lesser inventory declines are, and they're in areas that are either more expensive, such as San Jose, Silicon Valley, or you have, for example, New York City, and then you have, for example, Baton Rouge, which actually has been hard hit by the 5 hurricanes last year. So there's been much more movement in terms of people moving in and out. So the inventory decline is lesser. Now, the slide that I'm showing you here is inventory by price range. So 50 to 75% represents those homes that are in 50 to 75% of median home price in that area. And then it goes all the way to 175 to 200. So our affordable range is highlighted here in yellow. That's the entry level of supply. And you can see the decline from the pre-pandemic darker blue times to lighter blue March 2021. But what's interesting here that even the higher priced inventory, which is outside this yellow square, they have declined just as much, or actually technically more on a relative basis. And all of them now are currently at 2 months supply or less. So basically that's saying in 2 months, everything that's currently available for sale would sell out. And why it's important to look at the higher priced inventory and decline in availability in that price range is because oftentimes, as the prices come down in higher price ranges, it trickles down to having more affordable, more inventory at the lower price levels. But because inventory supply is tight at all price ranges, there is clearly no opportunity there even to hope for some trickle down to entry level supply. Now, another thing, so we were looking at most of the data up to this point has been about on existing home sales. There's been quite a bit of new construction, and new construction activity has picked up pace, particularly since the drops or throughout we saw post Great Recession. And it's only now at about the level, at about average level of last several decades. But there is quite a bit of discrepancy in the rate of new construction across the country. So in some markets, particularly in the South, it's getting 50% of new construction. And areas, for example, on the West or mountain states where we've seen a lot of demand recently, there hasn't been a lot of new home construction. So that's important to keep in mind when we're thinking about new construction, is that it's not happening equally everywhere and in areas where we most need it. So the bars here on the right-hand side are showing you growth in new home construction. This is annual percent growth. This is at the last quarter of last year compared to 2019. And what stands out is that the metros that are affordable, that have high employment growth, and have outdoor amenities have had this highest growth in new home sales over the last year. So again, areas that there is more new construction are getting more employment, and hence in the slide that I'm going to show you, sorry, I'm going to skip to this slide real quick because it's a very key slide. So this is a correlation slide, which showing you on the bottom on the x-axis, it's showing you the ratio of employment growth to housing permit growth. And basically, the higher the ratio, the closer you're coming to 200%, that means you've added more employment than you have added housing units. On the y-axis, it's cumulative price growth over the last 9 years. So the states that are highlighted in the red circle are areas that have more employment growth relative to number of housing units added, and hence higher home price appreciation. So when we think going forward in terms of how are we going to slow down the home price appreciation, in thinking about sustainability of home price appreciation they've seen over the last year, it's not only going to come from existing inventory, but as you can see, new inventory is key in keeping that home price growth at a sustainable level. I think I don't have a lot of time, so I'm going to just skip the slides that I skipped earlier. But talking a little bit about what is the driver behind this high demand for homes. Obviously, we've talked a lot about what's happening with millennials. You're looking at here population distribution by age. In last year. So in last year, the bars in red represent millennial population that is between age 28 and 30. And they currently represent the largest age cohort in the country. The green bar is the median age of first-time home buyers. So as you've heard probably through many media reports recently, this largest age cohort, being millennials, are approaching that key median first-time home buying age. And that is why, in addition to having high demand from second home buyers, we've seen a large increase from millennial buyers and first-time buyers. And this actually comes a little bit more clear in this chart. Here I'm charting home purchase loan application by cohort over the last 6 years. And if you follow the red arrow, you can see the share of millennials went from 33% in 2014 to 54% in 2020. So now on an annual basis, that increase has been about 3 to 4 percentage points. But between 2019 and 2020, that increase was about 7 percentage points. So on one hand, we would have anyway seen 3 to 4 percentage points because that's where the trends were going in terms of millennial. But potentially you can think about it as demand that was pulled forward in 2020 from demand that would have happened in later years because of the pandemic, because of the need for more space, moving out to suburbs, low mortgage rates, and so a number of factors that really provided for a very favorable environment for those that can afford. So those were the ones that can afford. Now let's move to talk about the ones who are struggling. So the slide here is showing you what a household would need to come up with for a 3% down payment for median price home in these areas versus 10% down payment for a median price home. And then the red line is what the median financial asset holding of families headed by those under 35 years of age. So you can see that generally they have only about $8,500 in savings, but the amount of money that they need to come up for a down payment is much larger, particularly if you're thinking about 10% down payment. So the 10% down payment is the dark blue line, 3% is a lighter blue line.
Selma.
Yes.
Hi.
I'm running out of time.
On screen because I think we need to transition.
Okay. So I'm so sorry.
No, it's quite all right. Let me just say, folks, I mean, this is, first of all, Selma's presentation is rich in detail. And Selma, I hope we can share the slides with the audience. Is that all right?
Absolutely, yes.
Oh, great. No, because it is an amazing presentation and there's so much more to it. But, I just as a segue to Kara, I think what folks should take away from this is, so we're not building. We haven't been building since the 1970s, particularly not affordable housing units. The last time I saw the numbers, it was 425,000 a year of affordable units back in the 70s. We're only building 60,000 a year of affordable units now. So when you take that and couple it with what you're showing in terms of demographics, this is like, it's almost like a tsunami crashing on the shore.
Right.
Of course, there are going to be these impacts. So anyway, I thank you very much. Selma.
And I would gladly share the slides. And if anybody has any questions,
folks should come back and ask questions at the end. I now want to introduce. Thank you, Selma. I want to introduce Kara Ward, and I want to, before I do, just say Kara has been one of the folks that we have really leaned on very heavily over the last couple of years as we've developed the Affordable Homeownership Coalition, which is a bipartisan coalition focused on homeownership and affordable homeownership particularly. And sort of without her help and guidance, and Phil has been involved, and Kirk Willison, and of course John Taylor, and others, and we've had the home builders at various times, and the real estate professionals as well. But truthfully, Kara's been a huge reason why we've had any success with AHC. So let me introduce Kara Ward. Kara, thank you for your contribution here, and I'll get off screen.
Well, thanks for the warm introduction, Ed. One of the things I wanted to bring up with this audience is 4 topics that are in the discussions about housing policy and home ownership in Washington, D.C. right now. I'm going to keep it to 4, but there's probably a lot more that we could talk about. I'm going to start with the first 2 items, which is related to the late March release by President Biden in his 38-page overview of the American Jobs Plan. Some people are referring to this as the infrastructure package. Embedded in that plan is an anticipated $200 billion of new spending on housing. Details were a little sparse in the proposal, but close observers are familiar with the concepts in the proposal and recognize these ideas from draft legislation that's been circulating in Congress for a couple of months or years. So while the $200 billion of new spending is doubling the amount that House Democrats passed in a symbolic vote in June 2020, known as the Housing is Infrastructure Act, provisions related to single-family housing and home ownership were not originally in that infrastructure package. So anything that we're talking about here on home ownership is additive and a relatively new idea. So the first of the 4 things I'm going to talk about is the Neighborhood Homes Investment Act. That's embedded as a reference in the American Jobs Plan, and it's a $20 billion program that's a tax credit program covering the gap between the cost of building or renovating the homes and the price at which it could be sold to an owner-occupant of modest means. So under this plan, a private developer would rehabilitate or replace a family home in a low-income neighborhood and then receive a competitively awarded tax credit if the home is sold to an owner-occupant for less than the price at which the renovation costs added up to. More specifically, if the developers sell the home at no more than 4 times the local area median income, they're able to be eligible for this competitively awarded tax credit. So rehabilitation costs in excess of the sales price would be covered by the tax credit, capped at 35% of the eligible costs. There's a lot of details in this program that are worth going through, but the bottom line is that people expect that it'll produce $500,000 homes, and it could be renewed if the take-up on this program is successful and substantial. The second provision in the American Jobs Plan is the barriers to affordable housing development. So this is a mirror of a concept in a piece of legislation that's been kicking around for about 2 or 3 years, known as the Housing Supply and Affordability Act. And what it's trying to do is create a carrot for local governments and states to compete for grants through HUD if and conditioned upon the removal of regulatory barriers to affordable housing, like parking restrictions, accessory dwelling unit restrictions, single-family zoning restrictions, those sorts of concepts or other kinds of impediments to developing housing at an affordable rate is believed to be one of the ways to help encourage and lower the price of developing new properties. One of the things that's tough about this program, and that people are cautiously excited about the housing supply provisions, is that it's really, using a quote from a different colleague, it's a carrot when sticks are needed. So while it's trying to incentivize local governments to do something about regulatory barriers, local governments are generally populated by politicians who feel personally responsible for their communities in a way that can adopt sometimes known as a NIMBYism, a not in my backyard concept. So advocates are incredibly important here to help motivate their localities. The first place to advocate is in your front yard, in the front of your neighborhood, and talk about where and what kinds of growth you'd like to see in your communities. So while these two provisions, there's a tax credit for developers, which really operates more like an insurance policy for a developer who's trying to develop properties in low-income areas and rehabilitate or construct something that could be helpful for modest means individuals. It's really an insurance policy against financial losses in that transaction. And the second is a grant program to try to get state and local governments to release or relieve some of the regulatory burdens. The other two items I wanted to talk about are more current in the zeitgeist because they involve legislation that's already passed. So the first item is CARES Act forbearances. So if you recall, one of the early COVID relief measures included no doc, as I call them, forbearances for federal loans. So that's FHA, VA, USDA, and then Fannie and Freddie loans. It offered 12 months of forbearance, extended to 18 months. And for the most part, MBA has been tracking, the Mortgage Bankers Association has been tracking the take up of this program. And at its height, it was about 8% of those borrowers. Today, it's down to about 4 or 5%. But what happens to the families that come off of the forbearance program when they start to owe their mortgage payment again and need to figure out what's next? Some of the concepts that are floating around is a streamlined refinance product, which is a 20-year loan that amortizes at a 30-year rate. So that would be a lower monthly payment with federal subsidies to help bring that rate down. In this environment where we're at traditionally low interest rates, that could be helpful, but it may be of modest assistance. The second item, or fourth item, I should say, the second item that's kicking around currently, it may not require legislation or new interpretation of legislation and use of regulatory authorities, is this idea about owner occupancy restrictions. So we do anticipate that the sad circumstances of the end of the forbearance period and the way that the economy will recover is that some homeowners are going to find the need to downsize or relieve themselves of their current mortgage obligations and find new housing. So that means their house is going to go up on the market. Generally, that's good. I mean, there's new inventory available, first-time home buyers, move-up home buyers, everybody starts churning back through the mortgage process. However, there's a significant concern that these houses are going to get eaten up by all cash buyers, and these houses are going to be turned into rental properties, which doesn't accrete to the benefit of a homeowner building equity and wealth through the home. So federal policy is looking at ways to try to reduce the attractiveness of the all cash buyer. There's ways to do that probably in the way that Fannie Mae, Freddie Mac, or FHA, USDA, VA disposition properties that are in their portfolio once they're sort of foreclosed upon or deed in lieu or some sort of short sale back to them where they could prioritize owner occupants. But more likely than not, there's going to probably need to be some significant reinterpretation of the ability to market these properties in a what's sometimes called a first look to actual owner occupants over the all cash buyer who could promise to close in 10 days. So maybe slowing down closing so that there's no advantage to the all cash buyer is one available option that would be kind of manipulated through rules that apply to servicers through the state and some federal requirements. Those concepts, those are four concepts that I just covered, and all of those kind of touch on the inventory issues. The federal government, I'll say this in closing, and typically is done not much on inventory, or as we would say, supply side issue. They're much better on demand issues, pricing issues. So they're much better at figuring out ways to lower interest rates or improve down payments through tax credit, or make down payments perhaps available through tax credits, or just subsidizing a 30-year fixed rate loan. Who has 30 years to pay off anything? But they have traditionally not done a great job on making sure that there's hammer swinging and putting up brand new houses that are available for owner occupants. It's something that had happened in the past, probably prior to my birth and prior to most of our births here. But in the baby boom generation, there was a number of kinds of ideas to try to get people to buy houses at affordable rates and with an inventory that was available. That kind of thinking has to happen again, and the government should probably get back in the business of thinking about how it can bring back inventory. That's been the role of this group that you're talking to today, the Affordable Housing Homeownership Coalition. And I'll turn it back over to my colleagues to talk about how that's coming together and what the coalitions of support looks like.
Great, thank you so much, Kara. So I'll also talk through just a few different things. I'll give you some context for the Affordable Homeownership Coalition, the genesis of the Moonshot proposal, as well as the state of homeownership in the country and the role that the Black and Latino populations have to play in that. So a few years ago, NCRC assembled this bipartisan alliance of the nation's leading home mortgage lenders, home builders, real estate professionals, community development groups, civil rights organizations, and consumer advocates, none of whom are typical bedfellows, but all of whom are certainly committed to expanding homeownership opportunities for low and moderate income individuals. And they collectively, this group recognizes that we really need to be, for the good of the country and for our overall economy, we need to lead creation of more homes and more homeowners to really lift up socioeconomic conditions for, especially for low to moderate income households and for communities of color. You know, as the pandemic raged on, the Affordable Homeownership Coalition noticed that that we were certainly in this moment of reckoning, and that it could be a catalyst for good. If we seized this moment. So, you know, combined with the pandemic, the groundswell to address historic racism, and really a lot of unprecedented divisiveness that was taking place in the country and still is, we recognize that, you know, that this absence of inventory is connected to so many other things and is really complicating economic conditions for us in the country. And really the last great housing push was post-World War II. So a lot of folks are familiar with the GI Bill. That certainly helped to lift a lot of white households out of whatever their economic circumstance was into the middle class. That was not something that was really able to be taken advantage of by communities of color, because they were expressly prohibited and really systemically left out. So that's part of the impetus of doing something big and bold and systemic, because that's really what helped to lift so many families into the middle class. And that kind of big, bold action is what's going to need to take place for that to happen yet again for the rest of Americans. So early on in our conversation, Ed mentioned the Moonshot is building 20 homes by 2030. So why 20 million? It's really, that number, it represents roughly 50% increase over the high watermark for home building over this last decade. And it's really what is needed to be able to satisfy demand and to lift the rate of homeownership for the Black and Latino communities from their current levels up to 60%. So that's kind of the genesis of where that figure comes from. Why affordable homeownership in particular? Why is that our focus? You know, if you think about it from a purely ethos perspective, certainly no one dreams of being a renter. Immigrants don't come to this country dreaming of finding a better life that doesn't involve having a stake in the ground, a piece of the pie. So homeownership is really a fundamental first principle in the American dream, and that's something that should be extended to communities and will help as a primary source of American wealth building for all communities. In terms of the Black and Latino contributions in the state of American homeownership right now, there has been, you know, really a shortfall of home building to date, as you know, someone kind of walked through some of the stats of what it's looked like over the recent years. And the overall homeownership rate is predicted to drop by at least 3 percentage points by 2040. Now that's complicated by the fact that, of course, there's inventory shortages. The demographics, though, do play a role in that. And for the past decade, you know, communities of color led by Latinos have been responsible for homeownership gains in the country. And in fact, between 2020 and 2040, Urban Institute predicts that 70% of new homeowners are going to be Latino. And the other 30% are going to be largely other communities of color. So the growth in the country is really being driven by non-white individuals. And so we need to be able to understand what the needs are for those communities and to address those needs. And And certainly, being able to find an affordable home is a primary need, because if we address all of the appetite for consumption and the credit needs, and there isn't inventory to purchase, then that's an incomplete solution. So to give you a little bit of context for where we are right now with home ownership rates as of 2020, the black and white home ownership rates, the gap there is a staggering 31%. And though the gap is narrowed between Latino and white home ownership rates, it's still a 27% gap. So the absence of that home ownership as part of a wealth equation for these communities is something that we certainly would like to be able to address through these innovations that we're talking about. Just moving on from there, really the inventory shortage is something that we'd like to be able to address both in terms of homeownership preservation and new construction. So I'd love to be able to turn it back over to the rest of our group to be able to talk through some of the rest of the content, and then for us to kind of have that Q&A session.
Thank you, Marissa and Kara and Selma, for your comments. As Ed kicked this session off, by the way, I'm Phil Bracken. I am the Managing Director of VantageScore Solutions, and I'm going to come back to the name VantageScore Solutions in a moment. This entire session is about illuminating this crisis and asking for your assistance in delivering solutions for the consumers of America, that where the pent-up demand is just not meeting the demand for homeownership is not meeting its need because of the supply shortage. So let me just for a moment, many of you know that VantageScore Solutions is a wonderful credit score model development company. As many of you know, we know that we can provide a credit score to 40 million consumers that can't get one through traditional sources. Nearly 10 million of those people might be mortgage eligible with scores of 620 up, and about 2.4 million of them would be Black and Hispanic. While that's great, wonderful, we're expanding that the pool of progressive opportunity for homeowners. It's also, just one of the things that illuminates and crystallizes this crisis that we are in. The demand for home ownership is at its highest level in the last 10 years, maybe ever, with the lowest mortgage interest rates nearly ever. And when you have a situation like that with extraordinary demand and limited supply, it is a magnet for investors to come into this marketplace to purchase with single family residential properties for investment to use for rental to the owner occupants that would have been the people that would be purchasing these properties. That phenomenon is on us, and it is a crisis. There are things that can be done with intervention. One of the things that I wanted to just crystallize for all of you, I'm thrilled to be part of NCRC's long history, having spent 20 years participating in the Mortgage Collaborative Group and the Bankers Collaborative. And my good friend John Taylor and I decided at the behest of the Mortgage Collaborative to start this Affordable Homeownership Coalition. This problem in America is not going to get fixed without intervention. The following things that I'm going to mention are not policy positions of VantageScore, but I just wanted to mention them as they have emitted from the work of this coalition that works hard on defining these difficulties and identifying some of the challenges and maybe solutions. I only want to highlight just 3 or 4 things here. The first of which is acquisition, development, and construction financing. For most of you that know the way this process works, regulators impose restrictions on banks that make loans available to developers and builders to to do the acquisition of land and development and construction of single-family homes. That process takes a number of years. In the Great Recession, the regulators imposed some incredibly stiff restrictions on banks that in turn, when passed on to the home builders, essentially said required or forced them to shut down much of the new construction of affordable property in America. Until recently, those unfortunately, those restrictions were still in place. They have been lifted somewhat recently, but certainly not to a point where they have become stimulus. And this coalition would really embrace a new look by the regulators of, property values are not going down. The risk of acquisition, development, construction is nowhere near what it was 3 years ago, and certainly not what it was during the Great Recession. So just rethinking that relief for acquisition, development, construction financing so that home builders can be provided a real landscape to build affordable property is a really important piece of this of our ask. Many of you have just seen these recent articles about lumber costs going up. 2 years ago, the average board foot cost for lumber was about $400. It's now at about $1,600. Part of that is because of these tariffs that are being imposed on Canada and other places to import lumber in the US. When compounded with some of the harvesting and environmental issues that we deal with in America, it becomes it builds a shortage of lumber and inventory, to the extent that many of the builders in America are actually having to import lumber from Russia, and it just that doesn't make sense. These tariffs and some of these other issues, we need relaxation of these so that we can actually meet the needs of the consumer in America. I might also just mention, if you haven't seen the reports, please go to the NAHB, the National Association of Home Builders website. The average compliance and regulatory cost for a builder to build the average home in America has just risen to $94,000 per house, up from $84,000 per house in 2016. There is no way we are going to have affordable housing built in America and meet the needs of affordable home ownership unless we cure this problem of extraordinary regulatory and compliance costs for home builders. I'll just end with a couple of other things. Kara mentioned a first look program. Boy, that would be really great for the aspiring homeowner of America to be able to have government agencies, whether it's Fannie Mae, Freddie Mac, FHA, VA, rural housing, whatever the agency may be, to extend a real first look program for owner occupants that need financing to be able to get access to these affordable properties that today are being purchased time and time again by institutional investors. I might just mention two more quick things. Certainly, we would love to see a revitalization of the FHA 203K mortgage program that allows for rehabilitation of construction of properties in the urban markets of America. You know, many cities of America own real estate, single-family homes from tax sale and other things, and it would be fabulous for those cities and other nonprofits as to be able to get access to an affordable program for rehabilitation of those properties with 30-year fixed rate mortgages included in them, and those mortgages are assumable. So a wonderful program that we're working hard to get reconstituted. And last, Kara mentioned all of the things that are being contemplated in Washington right now. We don't want to leave this without just making sure everyone here knows that housing is infrastructure, and we must embrace that. And gosh, wouldn't it be great to have a tax incentive for sellers of property under $300,000 in America to stimulate and motivate their the supply of property that would be available. I wanted to thank NCRC for its leadership in all of this. It's been wonderful. We've got a lot of work yet to do, and we need your help, and we need your oar in the water with us. So with that, I'll just turn it back over to Ed.
Thank you, Phil. And let's bring everybody up if we could, so that we can have a kind of round robin conversation. Here we go. There's so much here to talk about that it's unfortunate we only have an hour, but let's get to a couple of quick points. We said 20 million and Marissa explained why, but honestly, when you look at the shortfall, I'm not even sure 20 million is going to be enough. But to do that, we have to build at a much higher clip than we're building. And in order to get that done, we have to have a very different permitting, zoning setup than we've got in the US right now. My question, I guess, to the panel is, what kind of zoning and permitting changes do you think we need to have? And who's doing it right now? Is there anybody that you think we can point to say, hey, there's really good, innovative stuff happening here?
Ed, it's Phil. Let me just take one quick point and then turn it over to the rest of the team. It is unfortunate that a few years ago, the administration decided to do away with the affirmatively furthering fair housing responsibility of every city in America in order for them to get what are called community block grant development block grants.
Yeah.
If there were incentives for cities to receive that money for them to inspire affirmatively furthering fair housing, wherever those cities are at, if they want funding from the government, it would be a great thing for them to maybe be pointed towards relaxation of zoning and other kinds of restrictions that are today problematic for building single family homes.
Other folks?
Sure. So one of the vanguards in this area have been advocates known as YIMbees, Yes in My Backyard. And they really started organizing in a major way out in Minnesota and importantly in Washington State. And what they've done there is working to remove single family zoning restrictions, sometimes called up zoning, which means that you're allowed to build higher density housing in an area. Now that doesn't do much for home ownership, but it certainly does a lot for relieving the affordable housing crisis, which if you follow the breadcrumbs can relieve like rent pressures and allow people to save more for down payments because they're not paying so much in rent. But in the cumulative kind of impact of these different localities' restrictions, the tools that the localities have used to exclude higher density living or make it more expensive to get permits to build lower cost housing are as varied as possible. And I think one of the things that are very important is creating like a common set of terms so that we understand what is preventing homeownership from becoming more widely available. The National Association of Home Builders just put out a study that said that the regulatory overhang, the regulatory cost to construct a new home right now is $93,000 per house before you put a shovel in the ground and find workers and someone to buy the house. Yep, $93,000. That's up from about $80,000, about half a decade ago. So the costs are increasing, and whether it's not having enough sewer pipes running out to a new neighborhood, or having a hard time getting a county inspector to come look at the electrical grid, who knows exactly what the problem in your locality is, but being able to describe it's going to be important. I'll pause there for 1 second to say that the idea of using carrots or incentives to get cities to change their mind is great, but a colleague and friend of mine said that sticks are probably necessary. And the last time the federal government really wanted states and localities to do something different is analogous to the times that they prevented federal housing or federal highway funds from going out the door until you raised your legal drinking age to 21. And there were a whole bunch of things of laws that allowed people to be drinking at age 18 to 21 or what have you. And it seemed like every state, Louisiana, excluded were able to figure out a way to get back their highway funds. And perhaps that kind of stick, the most regressive possible, is needed here. But first, we have to understand the problem. Like, what is holding back this community, and what are the terms we use to define it?
Excuse me.
And
Bless you.
Karen, if I could
Mute
just
fast enough.
if I could just add that housing is complicated, and it really is a sort of hyper local issue. So understanding some of those location specific complexities is incredibly important, and having that common vocabulary would be helpful in making sure that municipality to municipality, state to state, we're all talking about the same thing. One other thing I would mention is that the Affordable Homeownership Coalition also put together a compendium of some innovations that are taking place across the country, which folks could download from our website to take a look at a variety of different, certainly approaches that are being taken at trying to solve for this problem.
And perhaps we can add that to the chat so folks can access it. Thank you for pointing that out, Marissa. I'm seeing some. I hadn't seen this until a few moments ago during the presentation, that your company did an analysis for the Wall Street Journal published today on the effect of the current housing market on houses in the $100,000 range, which is, I think, what you were showing us, that the rate of appreciation of houses, and we're talking about in neighborhoods like Youngstown, Ohio, and Cleveland and Detroit, places that had not really seen the housing boom until recently, suddenly are now the hottest markets in the country. So truly every single part of this country is now affected by this housing price surge, right?
Right. Actually, yes, I actually submitted that data to Wall Street Journal.
Congratulations.
Article. Yeah. So the question from the journalist was, what's been the impact on the sort of dilapidated areas from this current housing boom, and we did see cumulatively that appreciation has been larger for those areas than higher priced areas. But that actually to me points to one important thing about this discussion is that until we have more housing in general, we won't have more affordable housing. So this is not just
People have no place to move.
Exactly. So we need more housing everywhere and across all price ranges in order to be able to get to what we need in terms of affordable housing. So there's lots of noise here.
Yeah, no, thank you. That's a great point, Selma. There's so much to talk about here, but we did get a question, and I want to see who raised it. Sheila Sutton was talking about how it is that if we do get a chance to finally build some inventory, that folks can make a move into the middle class, particularly BIPOC communities. Because these are the folks that don't have generational wealth, don't have the down payment assistance, don't have the ability to sustain a hit in the case of a problem with a roof or HVAC. So what is it we can do, and what is being done? And maybe I'll start with you, Marissa, on this, because as the head of the CDFI, you're working on this. What are you seeing out there in the way of solutions to help people of color move into home ownership sustainably?
Yeah, thank you. Well, I mean, I think that there are a variety of different solutions that need to be put into play, and they differ depending on, honestly, on the segment of the community that we're talking about. One of the things that Selma noted is that the largest age cohort is 28 to 30, and that the median first-time home buyer age is 33. Well, last year, nearly half of all Latino buyers were under the age of 34. So like 2/3 of the Latino population are millennials or younger. And if we believe the data from Urban Institute that 70% of home buyers are going to be Latino between now and 2040, what we have is an increasing demand from a population that already has appetite. And that needs to be, the inventory issue is sort of the most acute need to solve for. The complexity in the solutions for the Black community is different. there's been about a 20 to 30% persistent gap in Black homeownership over the last 100 years. And it's not for lack of appetite, it's for a lot of systemic inequities. And so there are, to the question that Sheila asked, there are a lot of other sort of financial innovations that need to take place to make homes more affordable for, especially for folks from the Black community who are debt burdened, who have lower wealth, because the situations that they face in terms of having to pay for emergency things and they don't already have a lot of wealth that they can lean into, that sort of complicates that situation for them further. So, so there's a variety of different things that are at play, but certainly the inventory issue is most acute and needs to be solved for, and then a variety of different financial and financial services solutions need to be put into play.
And we're getting a comment on that point exactly from NCRC's General Counsel, Brad Blauer, who says one solution is for lenders to offer down payment assistance to minority borrowers as part of a special purpose credit program allowed under ECOA. And I think this is a vehicle that folks are just kind of realizing is there, and that we can make these kinds of special purpose. I think people worried about whether working with suspect classes would whether you could target specific suspect classes with help like this. And I think the answer is it looks as though we can. Carrie, you look like you're about to make a comment on that.
Yeah, so this is a concept, this down payment assistance program. Some people are referencing it as first generation home buyers, so people who grew up with parents who couldn't, or with a family that didn't have intergenerational wealth transfer, couldn't go to the bank of mom and dad for their down payment. And I want to hear Phil's position on it and talk about it. But there's a concept for a special down payment assistance program targeted particularly to first generation home buyers. In the administration right now, and talking in DC, there's a hesitancy to put forward another program that would amp up demand in a place where there's just no houses under $300,000 to buy.
Right.
So there's a desire to kind of like hold off for a second until we figure out how to make more houses that are $300,000 available, and that may not involve construction. That may involve like getting people to move out of their first time home buyer house and into the next house. Assuming that most people, yeah.
So, I want to say, first of all, because I know we're under a minute here, thank you all for this terrific panel. Folks, help us at the Affordable Homeownership Coalition move the needle here. We really need your participation. Weigh in. Let us know you're out there. If we can be of any help in getting you tools that you need in your local community, we'll do it. And we'd love to see you participating more directly. This is an idea whose time has come. We really do need to build this level of housing to have an impact, because there's going to be a nation of involuntary renters if we don't. With that, I thank the panel and thank you all for listening.
Thank you.